I've been a staunch believer of the BRICS. I'm not rooting for them. It's not in my best interest as an American because they basically are going to be not wanting to deal with America if they don't have to. But I really believe that's going to continue and grow larger and larger. And eventually gold will be used in some form with them in order to trade, whether it's just between themselves, an alternative to the dollar, whatever it may be. We're still probably 1 to 3 years away from that. So I think the physical bullion market still should continue well. I still said, and I said it when we just got above 2000, that we'll get to 3000 without ever going under 2000 again. I think that's coming. And 3000 is just a round number. There's not any specific reason to take that.
The gold market is experiencing resistance during early Asian trading hours, with prices hovering near $2,640 as a strengthening US dollar applies downward pressure following the release of US ISM Manufacturing PMI data. This price action reflects the interplay between various market forces affecting the precious metal. Central bank activity continues to emerge as a significant driver in the gold market. Forecasts indicate these institutions are expected to maintain substantial purchasing levels, with projections suggesting net acquisitions of approximately 8 million ounces in 2025, representing a slight moderation from 2024 levels. Market analyst Peter Grandich has expressed optimism regarding the physical gold market's trajectory. His analysis points to potential price targets of $3,000 per ounce, supported by what he identifies as robust demand fundamentals and evolving global economic dynamics. Grandich suggests the market has established strong support at the $2,000 level. Geopolitical tensions, particularly the ongoing situation in the Middle East, continue to influence gold's safe haven appeal. Recent developments in the Israel-Hamas conflict, including negotiations over the cessation of hostilities and reported casualties in Gaza, underscore the complex international backdrop against which gold prices are trading. The evolving landscape of international economic alliances, specifically the BRICS group, represents another significant factor in the gold market outlook. Discussions around alternative trade settlement mechanisms, including potential gold-backed systems, have gained prominence in international finance circles. Recent developments regarding Indonesia's relationship with BRICS highlight the ongoing evolution of global economic partnerships. Market participants should note that while current market dynamics suggest multiple supportive factors for gold prices, the strength of the US dollar remains a key consideration in near-term price action. The interplay between monetary policy, geopolitical developments, and shifting international trade patterns continues to shape the market landscape for this precious metal. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
My feeling, I think people should ask is, when they look of the tremendous gains it had, what really caused that gain? Well, we know really two reasons behind it, and it's not guessing. You can see it because there's proof for it. One is the tremendous amount of central bank buying. It is it has overwhelmed the paper market, and I think that is very, very critical. And the only two reasons that one can assume that those central banks have bought massive, because they're not speculating, they can't churn it and flip it to someone else. There's no one bigger to take it from them, is that they're buying it for two main reasons. One, they recognize that paper assets in general, potentially US assets, could be becoming very overpriced. One of the reasons why several of them have been liquidating a lot of the US assets. But there's going to be a change in the monetary system sometime because of all the world debt that's being created, not just here in the United States. Two, I think it also is because of of the formations of the BRICS. I've been a staunch believer of the BRICS. I'm not rooting for them. It's not in my best interest as an American because they basically are going to be not wanting to deal with America if they don't have to. But I really believe that's going to continue and grow larger and larger. And eventually gold will be used in some form with them in order to trade, whether it's just between themselves, an alternative to the dollar, whatever it may be. We're still probably 1 to 3 years away from that. So I think the physical bullion market still should continue well. I still said, and I said it when we just got above 2000, that we'll get to 3000 without ever going under 2000 again. I think that's coming. And 3000 is just a round number. There's not any specific reason to take that. I think the BRICS will use gold in some form, whether it's just internally on how they trade with themselves, potentially introduce some sort of currency or some type of basket that would include other commodities as well. I think the third chance, or the lesser of the three, is that they're going to introduce a whole new system to, to replace the dollar. I don't think it's in their best interest to do that. But I think that's coming, and that will keep the support for the physical bullion. Now, there's two things that I'm anticipating to happen, that in order to get gold much higher, if you want to believe in much higher prices, crypto cryptocurrencies have been eating the lunch of not as much gold, but the miners and especially the junior market, which I'll talk about in a moment. But it's also prevented some people who would have probably normally bought gold as a hedge. And right now they've tried hedging themselves in cryptocurrencies. I think as that market gets unmasked and people realize how much is being lost in these meme coins, for instance, a really nice guy that I've known for a while, big silver bug, huge daily show comments, just got out of that market to introduce his own meme, and he's into that. And these are all the things that happen at peaks, not in valleys or at bottoms and all. But I do think once the cryptocurrency market speculative fever slows or reverses, that will only aid gold. It'll continue to go because there's so much demand from the central banks. But when the public, which last year was almost a net seller of physical bullion, so I am looking for a banner year of M&A in the metals and mining industry. And one of the main reasons, and again, 98% of people listening to this should not even think about doing it, but I really plowed a lot of money into the junior sector, the smaller explorer types. And the reason I've done that is not only historically are they the most undervalued they've ever been, but at the end of the day, don't worry, be happy, crowd's right about growth and all the things that we need and EV and all that stuff. The need for new metal discoveries in order to sustain or even grow economies is so acute now.
The United States fiscal landscape faces significant challenges as federal debt reaches $36 trillion, encompassing both public debt and intragovernmental holdings. This figure represents a complex financial obligation that includes external debt owed to various creditors and internal debt held by government trust funds and accounts. The fiscal trajectory has become increasingly concerning, with the COVID-19 pandemic serving as an accelerant to pre-existing structural challenges. While the pandemic response required substantial government spending, the underlying fiscal imbalances predated this crisis, suggesting deeper systemic issues in the nation's financial framework. Market analyst Peter Grandich highlights the multifaceted nature of America's debt challenge, pointing to accumulating obligations across federal, state, local, corporate, and consumer sectors. The absence of a comprehensive debt reduction strategy and specific fiscal policies, such as targeted tax reductions, may exacerbate deficit concerns. Additionally, the current interest rate environment poses particular challenges, as higher rates increase debt servicing costs and potentially impact overall economic stability. The Federal Reserve has revised its monetary policy projections, indicating a more conservative approach to rate adjustments. Current forecasts suggest approximately 2 rate cuts during their 8 policy meetings in 2025, totaling a half percentage point reduction. This represents a significant moderation from previous projections made in September, which had anticipated 4 quarter-point cuts totaling 1 percentage point. Let's get back to the interview.
How many people thought, if they ever said that, had any type of career in this business? Like I said, I'm into my 5th decade. If somebody ever told me, hey, in the history, uh, the Feds go from raising rates to cutting rates by 100 basis points, what do you think happened? We would all answer interest rates declined because that's what they're supposed to do. Yet in this instance, we're up a full 100 basis points from the Fed's first cut to its last. And that, I think, is the untold or untalked about story, that clearly the supposed reason for cutting interest rates is to make things less expensive, move the economy, all that jargon. And yet interest rates have gone up. And I think that's the big question. And I think the answer to that is what the don't worry, be happy crowd on Wall Street doesn't want to discuss, Daryl. And that is, people are recognizing, bond vigilantes expect, especially, that we can't continue on this out of control debt spiral that has no sign of ending. There's nothing in the new administration. People can talk all about how other positive reasons, supposedly a Trump administration is good for the market and all, but there isn't anywhere in his platform or any discussion at all of austerity, of stopping this. In fact, I think you could argue that based on all the people he's promising to not have to pay taxes and all this other stuff, that we could see the deficit grow larger and larger. I think that's one of the three big problems there. I think it's out of control debt, which not only is on a federal level, but state, local, consumer, and corporate. Clear retirement crisis, which people have not taken into account because there's two different worlds, if I may digress a little, Darryl. There's two different worlds existing now. There's the 10% and upper people. So in other words, the top 10% income people, not only are they not impacted, but they literally live in a different world. They're not affected by what you and I each day have to deal with. Now, the 90% of the world, many of those people are going backwards. In fact, now we're told one out of every four workers in America is using a credit card in order to sustain daily life. That can't continue, especially when the debt interest is well above 20%. Uh, so a retirement crisis with two-thirds of Americans only working paycheck to paycheck gets worse each year because as everybody's getting older and unable to retire, listen, I can just tell you somebody that hit 68, it's a lot harder to live everyday life than it was at 48 and 38 and 28. And that's another with an aging population is going to play a role. But the third one, the third factor, which really no one's talking about, and I don't say no one, it's not part of the everyday discussion. And I think it's going to become an acute recognized problem in 2025 and beyond. And that's the crumbling infrastructure in America. Uh, let's not forget that we go all the way back to the first quantitative easing when Bernanke stood there with Obama after the 2008 crisis and said, we're creating all this money so we can rebuild America, and the money's going to be put to fix infrastructure and blah, 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 blah. It never made it there. It stayed in Wall Street mostly. It never made it to Main Street. And ever since. And don't forget, Biden also announced in his administration how they were going to fix infrastructure and all. I can tell you right now, in my home state, Darryl, of New Jersey, there are considered over 100 bridges that should be closed down immediately. That people are concerned they can literally just fall on the ground. Now we've seen that. And we keep treating them as isolated incidents, but A, they're getting bigger and they're becoming more common.
The confluence of international monetary realignment, evolving geopolitical relationships, and domestic economic pressures creates an environment ripe for strategic portfolio adjustments. As central banks worldwide continue their substantial bullion acquisitions and global alliances reshape trade mechanisms, the implications extend far beyond conventional market analyses. The Federal Reserve's measured approach to monetary policy and unprecedented debt levels suggest a transformative period ahead for institutional and retail investors. What factors do you believe will profoundly impact asset valuations as global economic partnerships evolve? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.